Imagine this. In the heart of America's financial empire, where trillions flow through invisible veins of code and capital, the giants of Wall Street have just posted record-breaking profits from a quarter that should have been a triumph. Yet, buried in the fine print of their disclosures, a chilling signal emerges, one that whispers of crumbling fortifications just as storm clouds gather on the economic horizon. What if the very surge in revenues that's being celebrated is masking a deliberate erosion of the buffers that once shielded us from catastrophe? What if, right now, as we speak in early 2026, these banks are gambling with the stability of the entire system, betting that good times will roll on forever? The truth is far more precarious than the headlines suggest. And by the time you understand why they're quietly dialing back their defenses, it might already be too late to protect what's yours. But stay with me. Because what unfolds next isn't just a story of numbers, it's a revelation of how the pursuit of profit could unravel everything we take for granted. Let's pull back the curtain on what happened in the final quarter of 2025. A period that, on the surface, looked like a resounding victory for the U.S. banking sector. Major institutions, from the behemoths like JP Chase to regional powerhouses, reported broad-based revenue growth that outpaced expectations. Median revenues across the largest 18 banks climbed nearly 6% year over year, fueled by a resurgence in lending activity and a rebound in fee-based businesses. Investment banking fees surged as mergers and acquisitions picked up steam after years of caution. While trading desks capitalized on market volatility, driven by geopolitical tensions and policy shifts, net interest income, that critical lifeline for banks, held steady or even expanded in some cases. Thanks to loans growing at an accelerated pace, up to 5% annually across the industry, with commercial lending leading the charge as businesses borrowed more to fuel expansion in a seemingly resilient economy. Executives on earnings calls painted pictures of optimism, touting consumer spending that remained robust despite lingering inflation pressures, and deposit bases that, while shifting, provided ample liquidity. It was the kind of performance that should have sent stock prices soaring, a capstone to a year where bank shares outperformed broader markets. But beneath this veneer of success, something was stirring, an undercurrent of decisions that hinted at a more vulnerable future. Decisions that weren't accidents, but calculated moves in a high-stakes game. To grasp why this revenue surge isn't the unalloyed good news it appears, we need to delve into the mechanics of how banks build and maintain their capital buffers. Those invisible walls that protect against losses in tough times. Capital buffers, measured by ratios like the Common Equity Tier 1 or CET1, represent the high-quality capital banks hold relative to their risk-weighted assets. These aren't just regulatory checkboxes. They're the difference between survival and collapse. As we saw in past crises, when undercapitalized institutions toppled like dominoes, in Q4 2025, while revenues boomed, many banks signaled intentions to lower these buffers going forward. Why? Part of it stems from the very growth that's being cheered, loans expanding faster than capital accumulation, inflating risk-weighted assets and naturally pressuring ratios downward. For instance, at some large banks, risk-weighted assets grew by 3 to 4% quarter over quarter, outstripping the pace at which they were adding to their equity bases. Executives alluded to this in subtle ways during calls, mentioning plans for increased share buybacks and dividends, which effectively distribute capital back to shareholders rather than bolstering reserves. One analyst noted that while current CET1 ratios averaged around 13%, well above the regulatory minimum of 4.5% plus buffers, the trajectory points to a gradual decline, potentially dipping closer to 11 or 12% by the end of 2026 if growth continues unchecked. This isn't panic-inducing yet, but it's a shift from the post-2023 era when banks hoarded capital amid fears of recession. Now, with the economy humming, they're easing off the brakes, assuming the good times will insulate them from shocks. But what if they're wrong? Consider the deposit trends that accompanied this revenue windfall, trends that add another layer of complexity to the picture. Deposits, the cheap funding source that powers lending, showed signs of stabilization after years of outflows to higher-yielding alternatives like money market funds. In Q4 2025, total deposits across major banks grew modestly, about 2% on average, with some institutions like Bank of America reporting even stronger inflows from wealth management clients. However, the composition is changing. Non-interest-bearing deposits, the most profitable kind, continued to decline as customers chased yields in a still elevated rate environment. This shift forced banks to rely more on costlier funding sources, compressing net interest margins by a few basis points across the board. At Webster Financial, for example, margins slipped to 3.35%, hitting the lower end of guidance despite accelerating loan growth. This margin pressure, while not catastrophic, eats into the profitability gains from higher revenues, prompting banks to optimize elsewhere. And optimization often means trimming capital sales to boost returns on equity, a metric investors scrutinize intensely. But here's where the risk creeps in. If deposits become flightier in a downturn, say due to renewed inflation or geopolitical flare-ups, these lower buffers could amplify vulnerabilities, turning a minor liquidity hiccup into a full-blown squeeze. Analysts from firms like Fitch have flagged this, noting that while current capitalization remains robust, the signaled reductions could test resilience if economic winds turn adverse. As we peel back more layers, the asset quality story emerges as a quiet counterpoint to the revenue celebration, revealing why lower capital buffers might not be as benign as they seem. Charge-offs, those actual losses from bad loans, ticked upward slightly in Q4, averaging 35 basis points across reporting banks, up from 28 in the prior quarter. Delinquencies in consumer portfolios, particularly credit cards, steadied after a period of improvement but showed no further decline, with Capital One reporting card loan growth stable at around 6%, yet warning of normalization in loss rates. Commercial real estate, that perennial worry spot, saw irregular losses but overall held steady, thanks to diversified portfolios, yet executives tempered their optimism, projecting charge-offs to remain in line with 2025 levels, assuming a soft landing. But acknowledging potential spikes if unemployment rises even modestly, this is the crux. The revenue surge is built on lending expansion in an environment where risks are normalizing, not vanishing. By signaling lower capital, banks are essentially saying they're comfortable with thinner cushions against these rising loss potentials. It's a bet on continued economic strength. But history teaches us that such bets often precede trouble. Remember, in the lead up to 2008, banks chased growth with lax reserves, only to find themselves exposed when the tide went out. Today, with federal debt soaring and interest rates still above pre-pandemic norms, the margin for error feels slimmer than ever. Now, let's connect these dots to the broader regulatory landscape, where signals of lower capitalization aren't happening in a vacuum. The Basel III Endgame rules, finalized in late 2025, require banks to hold more capital against operational risks, potentially increasing risk-weighted assets by 10 to 20% for the largest players. While implementation is phased in over years, banks are already positioning themselves, using strong Q4 earnings to justify capital returns rather than builds. JP Morgan, for instance, announced an expanded buyback program, citing confidence in their trajectory, even as their CET1 ratio edged down slightly to 15%. This proactive stance boosts short-term shareholder value, but raises questions about long-term fortitude. Regulators, including the Federal Reserve, have stressed the importance of maintaining buffers above minima. Yet with stress test results from mid-2025 showing banks passing with room to spare, the pressure to distribute is intense. But what if the next stress scenario incorporates hotter inflation or supply chain disruptions? Lower starting buffers could mean sharper capital hits, forcing banks to curtail lending just when the economy needs it most. This interplay between revenue highs and capitalization lows creates a tension that's palpable in market reactions. Stocks dipped post-earnings despite beats. As investors priced in the uncertainty of thinner defenses in an unpredictable world, shifting our gaze to the human element behind these numbers, it's worth exploring how this dynamic affects everyday Americans. The depositors and borrowers whose lives intersect with these institutional decisions. For the average consumer, the revenue surge translates to more accessible credit. Mortgage originations picked up in Q4 as rates dipped slightly, and auto loans grew amid resilient spending. But lower capital signals could indirectly tighten standards down the line, making it harder to qualify if risks mount. Small businesses, relying on bank lines for operations, might face higher costs or reduced availability if buffers constrain growth appetites. And for investors in bank stocks or ETFs, the allure of higher dividends from capital distributions is tempered by the specter of volatility. After all, a bank with slimmer buffers is more sensitive to economic wobbles. This isn't abstract. It's the fabric of financial security. In communities across the U.S., from bustling New York to quiet Midwestern towns, these shifts could amplify inequalities, rewarding those with strong credit while sidelining the vulnerable. As one economist put it, the bank's confidence in lowering buffers assumes a Goldilocks economy. But reality rarely stays just right for long. Here's where the narrative takes a sharper turn, a midpoint revelation that reframes everything we've discussed so far. Despite the triumphant revenue figures, a closer look at the H8 data from the Federal Reserve, released just days ago in early 2026, shows a sharp acceleration in banks' balance sheet expansion, driven not just by loans, but by increased holdings of securities and reserves. This growth, while supporting revenues, is inflating risk-weighted assets at a pace that outstrips capital generation, effectively forcing those lower buffer signals. But the twist? It's not organic demand alone. It's partly a response to the end of quantitative tightening. With the Fed signaling more liquidity injections to counter potential slowdowns, banks are bulking up assets in anticipation, yet choosing to signal lower capitalization to maintain return metrics. This contradiction, expanding aggressively while thinning defenses, exposes a gamble on perpetual stability. If inflation reaccelerates or a geopolitical event spikes rates, these expanded balance sheets could become liabilities. with lower buffers offering less protection. Suddenly, the revenue surge looks less like mastery and more like hubris, a setup for a reckoning that echoes the overleveraging of past booms. This isn't just data, it's a warning that the system's resilience is being tested in real time, forcing us to question whether the pursuit of growth is blinding leaders to emerging cracks. Building on this twist, let's examine the forward guidance from bank leaders, guidance that heightens the urgency of these signals. In earnings calls, CFOs projected continued loan growth into 2026, with net interest income expected to rise modestly as deposits stabilize and legacy assets reprice upward. Fee income from wealth management and capital markets is forecasted to remain strong, assuming market confidence holds. Yet, woven into these outlooks are caveats about capitalization. Many banks indicated plans to operate closer to their internal targets, implying CET1 ratios trending downward by 50 to 100 basis points over the year. Wells Fargo, for one, highlighted efficiency initiatives that include capital optimization, while Citigroup emphasized shareholder returns amid their transformation. This forward-leaning posture assumes benign conditions, no major recessions, no sudden rate hikes, but the global backdrop is anything but certain. With U.S. debt surpassing 130% of GDP and international tensions simmering, any disruption could cascade through the system. Lower buffers mean less room to absorb shocks, potentially leading to credit crunches that stifle recovery. It's a high-wire act where the revenue surge provides the net, but one that's fraying at the edges. As tension mounts, we approach the heart of what this all means for the financial ecosystem, where individual bank decisions aggregate into systemic risks. Imagine a scenario where lower capital buffers coincide with a mild downturn. Charge-offs spike to 50 basis points, eroding equity faster than anticipated. Banks, facing regulatory scrutiny, pull back on lending, exacerbating the slowdown and creating a feedback loop. This isn't speculation. It's patterned on historical precedents like the regional bank turmoil of 2023, when rapid rate hikes exposed weaknesses. Today, with buffers signaled lower amid revenue highs, the industry is more interconnected than ever. Derivatives exposures tie fortunes together, and a stumble by one could ripple widely. Rating agencies like Fitch have maintained stable outlooks for now, citing the sector's overall strength, but they've noted the capitalization trajectory as a watch point, potentially pressuring ratings if declines accelerate. For the economy at large, this could manifest as higher borrowing costs for households and firms, dampening investment and consumption just as growth shows signs of fatigue. The revenue surge, then, becomes a double-edged sword. It bolsters confidence short-term, but sows seeds of doubt about sustainability. Pushing deeper into the implications, consider the role of technology and innovation in this landscape, factors that both drive revenues and complicate capitalization. Fintech integrations have boosted fee income through partnerships, but they also introduce new risks, inflating operational RWAs under Basel rules. Banks signaling lower buffers are navigating this by prioritizing digital efficiency. Yet it adds opacity. How resilient are cyber defenses with thinner capital? In Q4, some institutions reported upticks in tech spending, offsetting revenue gains, which indirectly pressures buffers by diverting funds from reserves. This tech revenue nexus is thrilling but treacherous, as a major breach could deplete capital swiftly. Layer in AI-driven lending decisions, which accelerated loan growth but might overlook nuanced risks. And the picture darkens. The surge hides these evolving threats, making lower buffer signals feel like a quiet admission that the game has changed. With banks betting on innovation to outpace vulnerabilities, the climax builds inexorably toward a core truth. This revenue surge, while genuine, is propping up a system where lower capital buffers signal a shift from caution to complacency, a shift that could prove fateful if unaddressed. In the aggregate, across the 18 banks, median CET1 dipped fractionally in Q4 to 12.8%, with projections for further moderation as RWAs swell with loan books. This isn't alarmism, it's arithmetic. Growth at 5% demands capital accretion to match, yet distributions are ramping up, siphoning it away. The unavoidable realization hits. Banks are optimizing for now, assuming the Fed's dovish stance will cushion any blows. But if policy tightens or exogenous shocks hit, these buffers won't suffice. The 2023 bank failures reminded us how quickly confidence evaporates. Now, with revenues masking the erosion, the stage is set for a repeat unless vigilance prevails. It's a moment of reckoning, where the highs of Q4 2025 collide with the realities of finite resilience, forcing a reevaluation of what strong truly means in an uncertain world. As the dust settles on this revelation, we're left with a profound reflection on the fragility woven into prosperity. The U.S. banks' signal of lower capital buffers amid a revenue surge isn't a harbinger of immediate doom, but a cautionary tale of how success can breed overreach. For viewers who've journeyed through this narrative, the takeaway is empowerment. Understand the signals, diversify exposures, and question the optimism. In a world where financial titans shape destinies, knowledge of these undercurrents equips you to navigate what's next. Perhaps this is the edge, the rare insight that turns vulnerability into vigilance. ensuring that when the next chapter unfolds, you're not caught off guard but ready to thrive. The system's pulse beats strong for now, but its rhythm hints at changes ahead, reminding us that true stability demands eternal watchfulness.